Well, folks, again, welcome. We are very honored and grateful to have everyone here to not our first, but it's first in a while, Kimble Charting Solutions Rare Technical Events webinar. Going to be presented today by Chris Kimble and Ryan Dietrich. My name is Rick Bertino. I've known Chris since 2005 and been with him since 2011. And Ryan's a new name that is joining us, so we're gonna introduce him shortly. But we're very grateful everyone's here. Again, there's 1,000 or more than 1,000 people who've registered for this, so we're excited to have everyone here. And of course, for those who couldn't make it, or if for some reason you have to get out early, we are recording this. If again you have some questions along the way, please type them in chat or your question box, and we will probably get back to you with an answer following the webinar. So we appreciate your patience there. Just for the amount of information we've got to go through today, we may not necessarily get to be able to get to questions and so forth. So I'm going to see if I can get control here and advance the slides. There we go. I want to cover just a little bit of housekeeping, folks, for today's format. You can see our ugly mugs up there, and I want to just mention that I'm going to kick things off, and Chris and Ryan then will take this over for the bulk of the presentation today. And then at the end, we want to invite you to our next webinar, which we're going to have in 3 weeks. So you'll want to calendar that, and Chris will go through that with you. We are also going to offer, for those of you who are with us and have been with us as subscribers, as subscriber members, we're honored to have you here, and some of you have done trials, some of you have been with us for a long time. But those of you who don't yet know a lot about us or the research that we offer on a paid basis, because remember, many of you may just be a part of the blog and getting the free posts now, we are going to offer a trial at the end of this webinar, and also we're going to pick out a winner for a 3-month trial. So yes, you got to stay to the end or close to the end. Now there's a part where I say the end that covers the trial offer and the 3-month trial, and then we're going to wrap it up. But after we close that part, we're going to then cover the product descriptions. We respect your time. You don't have a lot of time to maybe go through and stay for everything. And some of you, again, being customers right now, don't need to know about our products. We're going to hold that to the end, basically at the end. I'm going to then cover that area. And the products for anyone who needs more descriptions of our products and the differences between them, how to make a wise selection. I'll go through that. So again, some of you are new to us, some of you have been with us for years, and hopefully those who have been with us for years, these desired takeaways that we have for you are already well ingrained in you. But for many of you, you're new to Kimble charting, and there's some things that we hope through this webinar, through the research that we continue to provide to you following today, there's some takeaways that we really desire for you. And one of them, the first one being a friend of Chris's coined a phrase, 28-second advantage. And all it means is that our goal for you is to provide you information that takes you very little time to see and understand the opportunity and risks that are presented and the action to take. So in some ways, 28 seconds is actually a misnomer. We hope within a couple of seconds you figure out the chart, the pattern, and any action to take. So that's goal number one, if you will, or desire for a takeaway from today. Another one is that we want you to see us hopefully as the resource for quality, relevant chart, pattern, and statistical analysis. The chart pattern analysis from Chris, and statistical analysis is going to come from Ryan. And another way we have phrased that is the power of the pattern and now the power of the statistics. So you'll hear that phrase going forward. We also hope you see us as a resource that you walk away saying, these guys have really helped me improve the timeliness and confidence in my investment decisions. Confidence probably is the one to emphasize. Timeliness we all want, but confidence to pull the trigger is a whole different ballgame. We hope we can impart that on all of you following today. And then, of course, give you a perspective on the markets and investing that you can't get anywhere else. I'm actually stealing that from a couple of our our member subscribers. They have shared with us that they see things that we produce that they can't get anywhere else, and certainly we're proud of that, and certainly want to be unique in the market. And last, and probably most important, is providing you guys actionable ideas, education, and, as you well know from Chris's slides and the pictures, a little humor along the way. I'm going to spend 30 seconds on a little bit about what we are and how we help our member subscribers, and Chris and Ryan will get into that more with actual evidence. So, but again, for those of you who are real new to us, I just want to cover a little bit about what we are. Very simple, an investment research firm founded in 2010 by Chris Kimble. The most important thing Chris wants to provide people is research in the form of charts and actionable ideas to help people enlarge their portfolios, regardless of the market direction. So we're not bulls or bears, and Chris will talk about that. We're not focused on trying to figure out opportunities only to buy on the long side. If there's opportunities to short, we don't care. We just want to make you money regardless. How we help? Well, there's a lot of things that you'll see from us, but in a nutshell, we want to try to find chart patterns and relevant statistical data. Things that are at extremes. Find the extreme points of exhaustion or pressure that have a high probability to reverse or possibly break out. Either one, a reversal pattern or a breakout pattern, we're happy to see it. We're happy to capitalize on it, and we'll share it with you. So let's get to the meat. We're going to introduce the presenters, Chris Kimble and Ryan Dietrich. There's their mugs again, and I'm going to just say a little bit about Chris. Again, for those of you who aren't familiar with him, as well as Ryan, Chris is the founder, of course, and CEO of Kimble Charting. He has 33 years experience in the financial industry. 25 of them were actually as a financial planner before turning and helping people as a chart technician. Having a business and psychology background, he actually combines that. I'm not sure that's a good or bad thing. Chris will even admit that. But having that business and psychology background, he combines it with chart pattern analysis and sentiment to try to find investment opportunities for all of you. Chris's work has also been featured on CNBC, CBS Market Watch, Yahoo Finance, dshort.com. Many of you know Doug Short, and dshort's website is now Advisor Perspectives, as well as many other places that I'm sorry I didn't note some other important ones. But Chris is also married to Pam with 5 children, and I believe now 7 grandchildren. I think 6 of 7 grandchildren were born this year. I'm being a little facetious, but I'm not kidding you. There were several of them born this year, so they've got a big household these days. Ryan, we're going to go to Ryan Dietrich now, who's a former portfolio manager, market strategist with more than 15 years of trading and investing experience. Ryan focuses on using sentiment and quantified data to invest in today's market. He has been a common guest on CNBC, Fox Business, Bloomberg Television, quoted in outlets such as the Wall Street Journal, Market Watch, USA Today, Reuters, Associated Press. And Ryan is also married with, I believe, 3 children. And again, his work is now being incorporated, folks, in all of our research. This is something that is as new as of the last few weeks that you've seen some unique and different statistical data. We're really proud and honored to have him on board. So with that, I am going to flip the screen here and get to the first slide and pass it over to you, Chris.
Rick, thank you very much. Folks, we're really excited about today, and we'll try to be as efficient as we can. We'd like you to ask, questions if you put them in the lower right, but one of the biggest challenges we had today, there's a lot of great information laying on the floor, and so we'll cover that in future pieces. One of the things, everybody, I just kind of want to really emphasize is that this image has been one of my favorite for the last 15 years. I just want to let you know as a shop, we're not bulls or bears. Rick mentioned I got a psychology background, and I've always wondered which was more important, the business or psychology background that I've got. But, folks, being bullish or bearish is nothing more than a psychological state of mind, and it's not a strategy. And that's what we're here to talk about today is strategies from the power of the pattern to the power of the statistics. So I just kind of wanted to cover that. And again, thanks so much, for being here. This is my 35th year in the business, and really excited with you today and to share many new things. So one of the things that years ago I was, today's talk is a lot about perspectives, and I'd just be remiss if I didn't, bring up, one of my mentors and really good friends, John Templeton, and of course he's deceased, but from a perspective, everyone, he really changed my life, and I owe him a lot. And one of my obligations that I promised is, as I get a chance to speak with people, is he essentially, he didn't force me to, but he encouraged very, very heavily that I read this book. And it was The Extraordinary Popular Delusions and the Madness of Crowds, and I was really honored that he signed it, for me. But folks, if you can do anything, this book really changed my perspective, on things, and please go out and read it. It's a very, very available book, through Amazon, so give it a shot, folks. It's a great one, and I promise you'll probably never look at the investing scene, the same again. So today we're going to have some quizzes, and we want to be interactive and have some fun. And so we're about perspectives, and one of my perspective questions is, what type of investor are you that's on the line? And so we're going to pop up a quiz here in a second, and in the interest of time, I'm going to show these quizzes ahead of time, everybody. But when the quiz comes up, can you just do us a favor and just try to, they're not tough questions, but just answer them really quick. Like in 3 or 4 seconds. And so the first question is going to be, which best describes you as, are you an individual investor, a financial advisor, RIA, or a professional money manager? So the quiz is going to pop up right now. Please give it an answer, and everybody's going to see the results here. So go ahead, Emily. So the quiz should be popping up any second. Is it there? Okay, good. Okay, thank you, everybody. We'll close that window. And just to let you know that looks like 81% of the people in the audience today are individual investors, followed by, oh, there we are, followed by financial advisors at 13%, and 6% of you are professional money managers. So the next question that we would ask is, which best describes your investing style? Would you say that you're a buy and holder, a tactical or occasional change in your strategy, a swing trader, or a trend trader, or a day trader? So we're going to throw the question up now if you can answer that quickly. Thanks for doing a great job on that last one. Thanks, everybody. It looks like about 55% would be a trend trader, a swing trader, followed by the next biggest category being tactical, occasional adjustments, 4% buy and hold, and 7% day trader. Thanks, everybody. And we'll be asking some more of these, but I just kind of want to get a perspective on the audience, because perspective is a big piece of today's talk. So I want to ask you a quiz. I'll just ask you this question. Are these shapes that you see by the red arrows, are they the same color? And you just answered yourself yes or no. Now what I'd like you to do is to take one of your fingers, preferably your index finger, and lay it across this horizontal line. And just lay it up there on the screen. Go ahead and do it again if you want. I've seen some people do it 3 times, but you'll actually see these two shapes are the same color. And so, today's about perspective on the marketplace, and so we want to give you some unique perspectives from pattern analysis and unique perspectives from a statistical, side of the fence. One of the things I really, hope and pray in this piece, and when Ryan and I produce pieces for you, is you have this feeling that of this little kid, and I'll be very, very humble that often when Ryan sends me things, and I share them with my wife, this is kind of our look. Ryan does spectacular work, and I hope we've seen it over the years that sometimes we'll share a pattern that you might say the same thing. So just as a company from my heart, folks, we hope to share unique research that you can say we just don't see this anywhere around the world. So just kind of want to share, I'm really excited about today. Ryan and I have actually been doing work behind the scenes for about a year. I was really honored to get to meet him last year at the Stocktwits in California, thanks to Howard. And Ryan, I just want to let everybody know Ryan's now head of statistical strategies, for Kimble Charting Solutions. And so we believe in the power of the pattern. We believe in the power of the statistic. And today we want to show you that we really believe that we can help improve your investment decisions when both of those are combined. So one thing I want to share with you is that the name of our company, we're a team, everybody, is not Kimble Charting Problems. it's easy to turn on the news and see a lot of issues. The Fed's not doing the right things, and debt levels, ISIS, you name it. Just very humbly, folks, you're not going to hear that stuff from us. Our company is Kimble Charting Solutions, and we want to provide you with quality research solutions that can help empower you to make better decisions regardless of the market direction. So today, one of the things that we want to introduce is we're not going to try to change the industry, but we would really like to make the industry shape differently or look differently. So we're all well aware of fundamental analysis, and we're also aware of technical analysis. But today we want to bring something new to the table that we call performance analysis. And we would like to become, after you see today, your performance analysis headquarters. That's one of Ryan and I's big goals, and we'll share with you, later on what this is about. So when thinking of performance, and if we turn on the Weather Channel, we often see this during hurricane season, and this is what's called a probability cone. And so, the weathermen are not trying to say it's going to hit at this exact point, but as you could see, they predicted the hurricane is going to head up this way, but as the farther it gets, this cone starts widening out. Well, a lot of people don't want to be in the path of a hurricane, but we want to introduce something different that we call the cone of opportunity. And this is where Ryan comes in to really help us and to help you. Ryan just does a great job, and so what we're going to do in the performance analysis is we're going to take all kinds of statistical data from all assets around the world, and Ryan's going to do a lot of crunching, with them. And then our goal is to look for probability outcomes, or what we want to call is the cone of opportunity, that we can define and show you what the likelihood of future events are based upon the past. And Ryan's going to get a lot deeper into this. And so, right now, I'd like to talk about performance analysis, and we're going to turn it over to Ryan. And this little boy's talking about, he's got two fingers up, and I think actually this was Ryan, just a few years ago. He's a pretty young guy. But from a performance analysis, we're going to share with you two things today. One's called the 125.5 indicator, and the other is the mom and pop indicator. And so right now, we're going to turn it over to Ryan, and we're really excited for you guys to hear what he has to say. Thanks, Ryan. Go ahead.
All right. Thank you very much, Chris. Appreciate that. So I am very honored. I'll just take a second here. Very honored to be joining the team here. I've known Chris for several years, like we said, and we've definitely done a lot of work behind the scenes as well. Some of you probably have noticed a lot of my charts popping up here, various places, but it's exciting to be more out front about things. I kind of knew in January I really wanted to work with Chris. I was working on the RIA, just a quick story here, and Chris had a chart that looked at gold relative to crude, and it was flashing a major potential low in interest rates. So when you're talking about gold and crude, and it's actually spitting out something to talk about interest rates, and he was dead right. So I actually refinanced in late January and nailed the lows. And I said, that's awesome. He looks at things like that, because I look, as we'll get into, I look at a lot of different things, and they might seem crazy, but when you put them all together, it works. So that was just powerful, and I said, that's what I want to do. And now, fortunately, we are together. So this first chart, guys, this is something that I'm going to probably spend more time on than any other chart, because Chris and I have talked a lot about this, and it's pretty important. When you get down to it, the S&P 500 has had an incredible run. The last 3 years, and let's just take a 30,000 foot look at things. The last 3 years, S&P is up 10% on average. It's only done 4 years at 10%, just 3 other times in the history of the stock market. And one time it got to 5 in the mid-90s, but we're getting a little extreme here. Let's talk about the Dow just for a second. Dow's up 6 years in a row. So going back to 1871, that's only happened one other time in the mid-90s. Went up 9 years in a row. Then we had a record down 3 years in a row. So we've had this big run. But this indicator is something that is extremely important, and it kind of builds on what I just talked about. We know we've had a big run, so what's it mean? Well, this indicator we've kind of coined the 125.5 indicator. And what it means is when the S&P 500 is up 125% over a 5-year time frame, we get a signal. And you can see on the chart here, those are the little red dots. Now, hopefully this works. There we go. Good. All right. If you just took a blindfold and threw a dart at this dartboard, we'll call it, anywhere it lands, as you can see, the average returns in S&P 500. 1 year later, about 7.5%. 5 year later, 40%. So let's look at that. If you had $1,000, you'd have $1,400 in 5 years. Here's the good one. 10 years later, that $1,000 up about 103%. Let's just call it you've made $2,000. And you doubled your money in essence, up about 77% of the time. So about 80% of the time, we'll just say you throw that dart, you're going to have a tailwind. The market usually goes up. That's just how it works. But, let's just say again, you're unlucky. You throw that dart and you hit one of these red arrows, or red circles. And, what does that mean? Well, that means things might not be so great. 1 year later, when the 125.5 signal hits, the S&P 500 is negative, almost 2%. 5 years later, you're down 20%. 10 years later, you're up just 9% on average. When you consider inflation's around about 2 to 3%, you're probably losing money when you factor in inflation 10 years later. So this is kind of the stuff that we think about, like, wow, this is powerful. And we just had a signal last March. Now, is that the end-all be-all, this signal last March? Well, we're up about 10% since last March. And there have been other times. And the first time this signaled back in 1928, over the next year and a half, the S&P actually gained 50%. In the late 90s, this thing triggered, and we gained about another 40% of the S&P 500. So, 87, it triggered in January, had a tremendous 30% rally until the crash in October 1987. What Chris and I are getting at is this signal is a warning sign potentially that I see some people are buy and holders. I see 35% of you are tactical, and a lot of you consider yourself swing traders. This is interesting to everybody. And the longer term buy and hold guys, maybe even the more tactical people, it's even more meaningful. So let's take one quick look here at just kind of comparing the two, and then we'll get to the next slide. 5 years later, buy and hold 42% approximately. But when you have the 125.5 signal hit, you're talking down 20% on average. The over-under performance is negative 146%. There's a big difference when this thing hits versus just blindly letting the bull market usually work. A little further out, 10 years later, we talked about it, you double your money usually on average. 10 years later, when this warning signal hits, you're up 9% on average 5 years later. The over-under performance going out 10 years is a negative 92%. So that's something that, this is something that you definitely need to pay attention to. If you're a day trader, sure, maybe you don't care as much, but for just about anybody else, this is a big deal. Let's get to the next slide here. Building on that, that was what I would call, I'm a technician by trade. I'm also a quant guy, as we'll get into with numbers. But that's the technical part of things. This is kind of the sentiment part of things, which I know I'm fascinated by and Chris is fascinated by. Our good friends at the Fed, what you think about the Fed, if you like them or you don't, our good friends at the Fed do a lot of awesome data if you go to the website. And I'm kind of a unique guy in that I love to go to the Fed's website, St. Louis Fed's website, and crunch data and just get it in Excel and just see what happens. And this is one of my hands down favorite bigger picture indicators. I know it's Chris's too. He's written about this many times in the blog. This is compiled by the Fed, and it's the household percentage of assets in equities. So again, let's take a look at this here. When this gets up here around 20, Chris and I just kind of ballparked, we said about 27%. That looks like potential warning sign. When there's 27% of someone's total assets in equities, that means, hey, maybe the mom and pop crowd, I should have said, we call this one the mom and pop indicator. So when mom and pop are getting a little excited about stocks and they have a little too much after big runs, that could be a potential warning sign. So let's get to the next one. What does it mean? I mean, this is where I come in play. Okay, so there's over 30% of someone's assets are in stocks. What does that even mean? So again, I go back to 1960. That's when this data started, and you can see those red dots are when more than 27% of someone's total worth is in stocks. Now here we go. This is the S&P 500 returns again. Now we're going since 1960 this time, but they're pretty similar to what we saw before. If you have $1,000, if you take that blindfold, put it back on, throw a dart, you're probably going to be doubling your money 10 years later, up about 85% of the time a year later. So that's great. But if you hit one of those red dots, what does that tell us? What happens? Well, as you probably guessed, the returns once again are pretty poor. A year later, we'll call it flat. 5 years later, you're up just 1%. 10 years later, up 6%. So again, when people are getting a little over the top, too extreme, a little too many equities in their overall market worth, that's maybe a warning sign. And this is, again, we're kind of comparing the two. The bottom line is the number negative 97% down there, the over/under performance. That's telling us that there's some big time underperformance likely when you go out 5 years, and then look at the 10-year returns. Again, 95% underperformance when these red dots are happening, and we've been having these red dots for the last year and a half. So again, it's important to note this hasn't signaled a bear market, and it doesn't mean that. But these are bigger picture concerns out there. Now, the neat thing is when you combine the two, and again, we don't have as many dots now. We had some dots back in the late 1990s. Again, the market didn't just roll over immediately, but again, at the start of the peak in 2000, when those started to trickle off, and we all know what happened. The market, we had a 50% correction. But if you factor in inflation, and someone bought, let's call it September, I think the peak was in August of 2000 in the S&P. Someone bought right there, factoring in inflation. They're actually right now still down when you factor in inflation. So that's a neat little stat for you there. You need to consider things like that. Why does that matter? Well, we just had this signal again last March, and against I'm sorry, not last March. It was March of last year, 2014. So about 18 months ago, about a 10% approximate gain in the S&P. But again, here's your numbers on what it's been doing, and here's the big one. This is what matters the most. What are the returns after those red dots signal? Again, we just had a red dot. So a year later, you're up 3% on average. I'm already telling you, 18 months later, we've still gained 10%. So that's not terrible. But here's the concerning part. 5 years later, it's happened 10 times. You're down 15% average. Never. S&P's never been higher 5 years later. So that's saying March of, I guess it'd be 2019. This stuff isn't perfect, but it's saying there could be, you might not have higher equity prices. Is what I'm getting at. 10 years later, you can see the returns there. Again, very poor. And again, this is the kind of summary of things. And again, what matters the most is the over/under performance at the bottom, negative 136% versus just blindly buying and holding, throwing your dart, letting the tailwinds lead you. There's a major headwind potentially in play with equities here. Then the bigger picture, 10-year. The next chart, I'm sorry, the next slide here kind of sums it all up for us. And I've already gone over these charts. Chris and I do have a lot of charts to go over, but the bottom line here, we ask the question, which red circle would you pick? And I don't know about you, but to me, none of those look very appealing whatsoever. And with that, I am now going to kick it back to Chris, who's going to look at what I think are some fascinating long-term power of the pattern charts. I just went over the power of the stats that kind of maybe there's some concerns. Chris has some great charts, and Chris, take it from here on the power of the pattern.
Great job, Ryan. Thank you very much. I'd like everybody to just kind of look at the screen because this talk is all about perspectives and how it impacts the action that you take. So I'd like you to look at this yellow dot right in the middle, stare at it, and then move your head forward and backwards against the screen. Do it a couple of times, and I think you're going to notice one, if not both of these things, rotate. When you move back and forth. So this is a unique. We're going to continue to try to provide unique perspectives on a research basis, to each of you. So one of the things that I wanted to look at is this is the S&P going back to the 1970s. So I highlighted a few fairly important dates: 1987 the low, the 2007 high, the 2009 low, and this year. And is there any chance that all of these dates could tie in together? I mean, they're important dates in our past, but could these dates from the past have some predictability to the future? So as we look at the screen, one of the things that stuck out to me is, you'll see right here, is that let's go and look at here it comes, the 1987 bottom and the 2009 financial crisis low. So these are two of the biggest or most important unique lows in the last 20, 30 years. So I applied the Fibonacci expansion level to each of those, and look where the 423 level comes in, which was about the 2100 level this year. So what's the chance if we take the 2007 high, the 2009 low, and apply Fibonacci expansion levels, and the 161 level meets here. I've never seen this before, folks, and so this is really interesting to me that we could take some of the most unique turning points, what I want to call emotive points, emotional points in society, and you could tie them together, and both of them meet at the exact same level, which is 2100 this year, and look what happens, to the market once it hit it this year. So what if we would just happen to tie in 1987 and 2003 to finish the slide? So we can see that we could take this channel line that this year when the S&P ran into this, it pretty much stopped on a dime. So this is really important to us when you see these type of things coming into play, when you see the 125.5 going off and the mom and pop indicator, being where it is. We saw the earlier survey that a lot of you are tactical investors. So what this would confirm with the data that Ryan had showed is pretty much you're in the right game plan, folks. Because the wind is in the face of investors, as Ryan discussed, historically for a while. Ryan talked about long-term charts. This is one that interests me, that this is a really important price point. This is the Dow going back, to the 1920s. And we've seen a fairly uniform, blue rising channel. You could see a breakout in the 90s, the 2003 decline. Look at that, folks, held at support. And then the majority of the 2009 financial crisis took place once the support channel broke. Now the S&P is back above it, and we're sitting right on it right now. So I'm well aware that people 70 years ago that were trading in the 30s are most likely not alive today, but I'll just be humbly, I don't know the answer, but charts seem to have memories. And we can see that this line that was in the 1990s was 60 years old or 55 years old, whatever. It meant something then. It meant something again in 2000, and it could mean something, again right now. So we're at a really critical long-term channel. And then zooming in just a little bit more, this is the S&P over the last quarter of a century, and you can see in the 1993, I just took this lower line and tied it into the financial crisis, laid it on top of the 2000 high, and you'll notice earlier this year, the market as it ran into the Fibonacci levels also ran into this channel level, stopped on a dime. So I took a parallel, everyone, of this long-term channel, and I laid it on the 2007 highs, and so you can see right now at 1, well, let's just go back a year, what Ryan and I want to call the Ebola low 1 year ago, and look where it stopped, right on that parallel line, and so we're right back there again. So we think from a short and a long-term perspective, the S&P and the Dow are at some pretty important levels. I hope that, from a perspective that, when you look at some of those and when you tie in those Fibonacci levels, that you could say, well, I've never seen something like that before, and that would be one of our major goals, is to share and change, perspectives, because these perspectives will impact the action that you take. So another, quiz real quick as we go to a different section. The question here would be, is the two orange dots in the middle of the blue, are they the same size? Yes or no? Give you a chance to think about it, but as you look at this illusion, is they are both the same exact size. So perspective again can impact things that we're doing. So in today's talk, what we're going to do is we're going to look back on a couple of examples that Ryan and I shared earlier in the year. The power of the pattern and the power of the stats was combined, and what the results were. Then we're going to go to a couple of things that we're excited about, that the power of the pattern and the stats are showing actionable ideas right now, and then a couple of more ideas that we'll share with you 3 weeks later. So we're going to pop up a quiz, the next one, here. So we see whatever this asset happens to be. You see that's done fairly well, started to curl a little bit. So my question would be is, what would you do with this pattern? So would you buy, sell, hold, or do nothing? So we're going to pop the quiz up right now, and I appreciate how quickly everybody's been responding to it. See if we can do that again. Thanks, everybody. So looks like 2/3 of the audience said they would sell the asset. So let's kind of go through from a power of the pattern perspective. Let's take that we can see that the asset that had been rising, and I tied a couple of the tops together, and Ryan and I started noticing earlier this year that this asset was spitting off bearish, or let me say, it was spitting off reversal patterns, and they were bearish wicks. So they were bearish reversal patterns that were taking place, and we started sharing this with members, and Ryan and I both shared this on our blogs and on Twitter and on StockTwits. So as we look, from a technical analysis, we see that looks like this rising channel, has broke. So maybe did we make the right decision? 2/3 said to sell this asset. So let's dig just a little bit, deeper, into this. But hey, just if anybody's curious what this asset is, this is IBB. This is the biotech ETF that's one of the leading sectors, in the States since 2009. So, we coined the Eiffel Tower pattern. We try to encourage people that if you see a pattern that looks like the left side of the Eiffel Tower, that you have to be pretty careful that when support breaks, the right side of the Eiffel can look like the left side. And so risk management becomes really key when you see these types, of patterns. So I'm going to turn it back over to Ryan. And when we started seeing these bearish wicks and some of the activity, of late, Ryan's done some really unique studies. So Ryan, why don't you tell us what you found?
Thanks, Chris. That's right. Real quickly, what we noticed back in March and in April on a monthly pattern, there are some historic reversals on IBB. Now, that didn't mean IBB slowed down. I mean, IBB eventually made new highs this fall, but that really got it on our radar that, hey, this thing could be tiring. It could be weakening, and if and when it cracks, it could be pretty spectacular, and that's kind of what we've seen. Now, on this chart here, though, once again, I put things through the cone of opportunity. I used thousands of data points, and I looked for the largest one-day drops for IBB ever. And you can see those are the red dots there. And we recently had a 6% drop, which is one of the lowest, one of the worst one-day returns ever for IBB. And then, what I do then is I'm like, let's take a look here and see what that means. Because look at the eyeball test, as those have been near some pretty good lows. Maybe that's actually bullish. But I like to use this power of the stats and confirm things. And sure enough, 1 month later, you can see there's only been 11 instances going back years. But 1 month later, IBB is up 11% on average. Median 11%, up 82% of the time. 3 months later, you're talking 17% on average. Pretty good median return, up 91% on average. So one day, big losses, they're scary. Believe me, Biotech was all over TV. I had reporters ask me about Biotech and those contrarian indicators, internal contrarian indicators start going off when I start hearing everybody talking about Biotech in the bear market and when they get all the stats on it. Believe me, I love doing the stats, but that makes me wonder, hey, maybe we're near some type of a potential, at least tradable low, and the power of the stats kind of confirm that. The next slide is another way to look at things. Again, these are the worst 8-day drops ever. And again, just look at the chart. We've seen some of these red dots when those things happen using the cone of opportunity, and they weren't too bad. Maybe you start looking to accumulate. And again, we just recently had a 20% drop in 8 days. One of the worst returns in 8 days ever. Only a streak in September. We'll put it this way: only right after 9/11 was there a worse 8-day drop for IBB. When you put it in that context, wow, this is something that's clearly been hit hard. Maybe there's something there. So this is where Chris and I kind of bounce back and forth and say, this is all over the place. But the power of the stats are saying, maybe there's something here. And on the bullish side, the contrarian side, I guess we'll call it now. I mean, we kind of mentioned why it looked weak, but maybe it looks good now. So at this point, I'm going to hand it back to Chris, and he's going to kind of show what the power of the pattern is showing right now with Biotech. Take it away, Chris.
Thanks, Ryan. Some pretty powerful stats. So as we look at this next chart, everybody, we're asking another quiz. So whatever this asset happens to be, you can see it's in a rising channel. If you look at the top of the screen, you can see that relative momentum is nearing the 2011 lows. It's as low as the Ebola low last year. It is at a Fibonacci, level right now. And then if you look in the lower right-hand corner, you'll also notice that volume is extremely high. And so we have a combination of low momentum, 4-year rising channel support, whether it was the Ebola low right here, everybody, or in 2011. So my question, we're going to pop up the quiz, is what would you do right now with this asset? Would you buy, sell, hold, or do nothing? Thanks again for answering very quickly, everybody. I hope you're having fun with that. It's really interesting perspectives to see. So right now we're coming back with about 70% of you would suggest to be a buyer, of this asset, And just to let you know what this is right now, this is a XBI. We all know that IBB is the most largest cap size. I think it's like 8 billion ETF, but this is another ETF that tends to do a little even better than IBB on the way up, and sometimes on the way down XBI could do the same. But so the takeaway here is huge declines. The power of the statistic is showing that when Ryan was looking, if you'd thrown the dart and hit any one of those orange dots that Ryan had showed in the prior slides, the future outcomes were really nice. But when it comes down to all of it, I think everybody on this phone call has like 3 things in common. We all know 2 of them, death and taxes, but in my opinion, the third one's we all trade price. And so this is at a very important price point. So this looks to be a very good entry point, and then we just would suggest that you'd set a stop right below that channel line, because if this does happen to be an Eiffel Tower pattern, regardless of the power of the stats, if we see some support break here, we could see a lot more selling, in the biotech, area. So one of the ones that I'm going to kind of change the screen just a fraction here, everybody, and I'm not going to do a quiz, but I want to ask you just a question. Is the square with the A letter in it, just the square itself, and then the square with the B letter, do they happen to be the same color? So are those 2 squares the same color, yes or no? And we're not going to go through a quiz, but we've had some fun with this. And so you'll notice the A square, and so I'm going to take this line and I'm going to lay it right on A so that you can see that it is a match. So I'm not playing with anything. So what if we would drag this same line that stays the same color down to the A and B squares? So you'll notice that that line disappeared at A and it also disappeared at B. So just to kind of let you know that from a perspective basis, it may not look like they are, but those 2 squares are the exact same color, and it's impacted by the shadow. So our investment decisions, folks, can be impacted by things in some ways that we're just maybe not even really aware of. So very, very important, in my opinion, from a perspective basis, kind of where we are. So we're going to ask we are going to ask a question here. So whatever this asset is, we're looking at the last 30 years, folks. And so you see a pennant pattern that looks near completion. Whatever this asset is on support. And so I'd ask the question, what would you do here with this asset on support? Would you buy, sell, hold, or do nothing? And here comes your quiz. So really interesting. There's 32% are buyers, through 32% are nothing, and 20% is sold. So a pretty good, mixed crowd, on the answers of that. And that's one of the characteristics of a pennant pattern, everybody. I want you to embrace this type of a pattern, but it does frustrate the bulls and bears because you have higher lows, lower highs, and higher lows, which tends to frustrate both the bulls and the bears as this narrows. But the best thing about these pennant patterns, folks, is once they break out, they really tend to run, very hard. So let's look at some action of what happened after that pennant pattern broke, right here. So now that this asset has fallen hard out of that pennant pattern, so congratulations to those that said you either do nothing or short this asset. I noticed that there was a bullish wick taking place, so I got on the phone and I also applied some power, the pattern to it, and so I got on the phone and I called Ryan. I said, Ryan, look at this. Whatever this asset is, it's got this channel down here in the early 80s, and if you run some of the resistance levels, this channels, it's making bullish wicks, right over here at this price point. And so I wanted to get in touch with Ryan and see what the power of the statistic, was sharing, on this. And just to let you know, I'm going to uncover each side. This is crude oil. And so this is a crude oil in March of this year. And so Ryan and I both wrote several pieces, on this. So I want to turn it over back to Ryan. To when I gave him a call, what did Ryan discover from a mathematical basis back in March when I was seeing, the support, huge decline, and the bullish reversal wicks taking place. So go ahead, Ryan.
Great. Yeah, thanks, Chris. Yeah, think back for a second, guys. Early March, one of the few things anybody thought looked good was crude, and rightfully so. It saw a historic drop. And again, this chart I created on March 17th. Chris and I were kicking around, what's it mean, what could be going on, and it's just a real simple chart. these are the pullbacks for crude from the all-time highs. And as you can see, March 17th, crude had pulled back about 70% from the all-time high. And that's meaningful to me, hopefully to you guys also, because you can look back in the history of crude. That's the ballpark where once you hit that negative 70, it definitely could go lower a little bit more. But that's the ballpark when some major, major lows have taken place. And that's kind of what really actually happened. If you look back, crude starting on March 18th formed that was the low. And it really, really did well the rest of the month. So the timing of making this chart was, I guess you could say, random or lucky, but at the same time, it was pretty fortunate. The next chart here. Let's see. I'm trying to get to the next chart, Chris. I'm hitting. Can you give me the next chart, maybe? There we go. Okay. The next chart. So again, so March 17th, there's a low. March 18th, it starts to go higher. And we saw a major reversal pattern back in March. And what I do then is, this is when Chris calls me and he says, hey, look at this, could be bouncing. The rest of the last 2 weeks of March, really good reversal, really big bounce. There's a panic, and everyone thinks crude oil. There are articles. You can go back and Google this. Articles on crude oil going back to $10, $10 back to $20 a barrel. And that's the sentiment we're looking for. But the chart needs to line up, and Chris showed why. And then I dig in with the power of the stats. And you can see here, what I did was we looked for a 10% bullish wick. What that means, it means crude finished 10% or more off of its monthly lows. So it had it ripped from the bottom, those March 18 lows at the end of March. So we had the wick pattern, and we kind of made some different charts. And we said, you know what, though? If you look at it, crude's been killed. So we added another layer to it. It's down 40% the previous year. This is where Chris and I start kicking things around and get pretty powerful. And it sure did. When you look at this, the returns there, 3 months later, up 12% on average, but higher 63% of the time. We said that's pretty good. But here's where we got excited about things. 6 months later, you're talking a 40% gain every single time it's been higher 6 months later. A year later, 50% rally, 100% of the time it's higher. 100% of the time, 12 months later, after you see one of these bullish wicks that we just saw in March. So around, late March, early April for sure, Chris and I were definitely bullish energy in general, and energy had a tremendous rally. Now I know it came back a little bit, but a tremendous rally for about 6 weeks. And this next chart's going to show you one of the greatest 2-month returns we've seen in history. This is just simply a 2-month returns on crude going back many, many years. And this is one of the eighth time that crude gained over 30% in a 2-month period. And again, when you factor all that in, this is talking crude. Many of the stocks, they usually gain a lot more on the upside and downside. I mean, a 30% move, someone might say that sounds like a lot, or doesn't sound like a lot, you could argue. But again, this kind of shows we hit I like to say, near historic move in crude. And when you look at the move some of the stocks did also, when you leverage that, it was really, really powerful. So the power of the pattern and power of the stats together back in March when we started kicking it around really seemed to work well. Now, I'll be honest with you. Here's old Tommy Lee. At turning points, you get the you can't be serious look is very common as Tommy's there. And when Chris was kicking around, hey, do you like crude here? I kind of, to myself, kind of had that, he can't be serious, is he? And in the beginning of the year, we had, believe me, guys, we cut out a lot of good slides because it's going to be tough to do this in an hour. And one of the things also we kind of came to was interest rates actually could form a major low and bounce, and we saw that earlier this year. I thought Chris was crazy then also. But again, that's kind of what we're looking for. I don't mean to sound, we're just looking for things to sound crazy, but the best trades are usually when nobody agrees with you. Look at that chart Chris showed with the animation on crude, and a lot of people didn't think you should sell it. And then we saw, I believe it was one of the largest 6-month drops in crude ever. And that's not to say make fun of the crowd or make fun of you guys polling. Believe me, the crowd is usually wrong, and we're looking for those extremes, and then we combine the power of the pattern and power of the stats. You can have one of the largest 30% moves in crude in history, and that's exactly what we're trying to do together, and we hope over time we will continue to do that. So now, enough about the past. Why are you guys here? You're here to make some money. Hopefully have some fun, learn something. But now we're going to talk about some things that we like going forward. And with that, Chris, I'll hand it right back to you.
Thanks, Ryan. Again, I want to talk about some unique perspectives and how perspectives impacts, your action. You can see this looks like a double image face. You see two different faces of the same person. So we want to talk about some what we want to look at as opportunities right now. Two different opportunities that the power of the pattern and the power of the statistics are spitting out. So Ryan, I want to give it back to you, and that because you started this conversation off a couple of weeks ago. So you just take this for one slide, Ryan, and we'll come back.
Sure. Yeah, this is Caterpillar, guys. And if you remember back a couple of weeks ago, Caterpillar had some very negative news. And you think back, though, let's talk about throwing that dart again. If you throw your dart, usually Caterpillar is going up. But let's say after a stock gets killed, and in this case killed, but what Chris and I kind of kicked around was negative 33% rate of change over the previous year. Those are those green dots. When I put all the thousands of data points back to 1970 with the cone of opportunity, it spits back the green dots, and those they come in clusters a lot of times, but they mark some pretty good lows. And one other chart, I know we're not showing it, but Caterpillar, I believe, was down 7 or 8% a couple weeks ago when I had that big gap. I also had a 6% gap. So I did all these different studies that said this is getting to the point of pretty extreme. And it's all over TV. Again, I love watching CNBC, and I mean, I've been on there, so I don't want to talk too negative about it, but I get some ideas. When they're all over something, that's usually a major time that you might want to go the other way, and Caterpillar was all over the place. So I dug in and said, hey, Chris, these power of the stats, they might be saying something. What's the power of the pattern saying? And Chris, you can take it from here and show what the power of the pattern said on Caterpillar.
Thanks, Ryan. So everybody, Ryan gave me a call and alerted me on what the statistics, were looking like. So this is a Caterpillar, and just wanted to share at that same time, what Ryan alerted me to this. So we looked into the power of the pattern, and this is, when it was really in the news, as Ryan said just not too long ago. So we look back over the last 25 years, you can see the relative momentum for Caterpillar, and the decline that it's had was very low. And at the same time, Caterpillar was at the bottom of this trading channel, and it was at its 50% level off of the last 15-year rally, the 50% fib level. So from an actionable idea, we still feel good about it. We picked up Caterpillar recently, premium members did, and it was kind of interesting that Ryan sent me this note this morning that I put on the screen from Bespoken, that premium members are long this piece, and we still feel really good about it, everybody, above this support line, but that this was from a Twitter message from Bespoken this morning that Caterpillar had its biggest 4-day gain, which was 12% since August of 2009. And so this is just an example, everybody, of a current trade, but also one that we've just done recently, where it was a combination of the power of the pattern and the power of the stats. Gave us a good risk-reward entry point. We knew where our stop was. We did go and harvest 20% of the position today, and so we picked up roughly the average gain around 8% in just a few days, and we still hold the remainder of that position with a stop just above our purchase price. So we've made enough gains that we actually moved our stop up, so even if our stop get hit, we'd make some money even on the remaining shares. So I want to ask you, when you look at this chart pattern, this is another opportunity that we see at hand. What do you see when you just first look at this? Do you see any opportunity? We're not going to ask a quiz right now, but I'd want you to think, in your mind, would you buy, sell, or hold? So this is again a 20-year chart. Excuse me. So let's take the highs. Let's parallel that line. Let's tie it into some lows. And so this interested me right in here from a power of the pattern perspective, that support was in play. But is that the only support line that you'd see? So let's bring a couple of other pieces in. So we looked at this as a dual support point that was of interest to us, and we're going to see in just the next slide Ryan's work on the power of the statistics. But as we pull things away, this is copper. So Ryan, on this next slide, I want you to share what you found from the power of the statistic as copper is hitting this dual support point.
All right, thanks, Chris. Yeah, so Chris, he was saying to me that, hey, copper potentially looks good here. And again, I kind of, from the sentiment point of view, just know what commodities are hated out there, and that's not a reason to just jump into something. But when there's a lot of hatred out there, that's how major lows can form. So let's just talk about copper just for a second. The average returns a year later since 1971. I've got my chart again, about 7% on average. Then I'll just jump all the way over to 10 years later, about 90% on average, higher about 57% of the time. But let's think back to that blindfold. And when you put that blindfold on and you throw that random dart, you know, these, and let's say you throw your dart and you hit one of those green circles. Well, those green circles signify a 4-year return down 40% or more. I'm trying to, let's see here. Here we go. And you do that, and if you were to hit one of those green dots, look at those returns. You know, a year later, copper is actually up about 16% average, about double their return. Now, 3 years later, about 5%, not as good, but where it really gets interesting, 5 and 10 years later, you can see it on your screen, these are significantly better returns when copper is down 40% or more on a 4-year basis. And remember those charts we showed earlier? You know, so let's say 10 years later, copper's up 150%. I was showing that the S&P, you know, using mom and pop indicator and the 25.5, S&P very well could be actually negative the next 10 years when you also factor in inflation. So that's something to consider. And a lot of these commodities, what's really interesting, it's almost like the calendar came. If you look at what these commodities do in October, they're really doing well. You know, silver, I think, is up 12 or 13% already for the month. Copper's doing well. Sugar's doing well. Carbon, I mean, these are all things Chris and I follow and we talk about a lot. You know, we're looking at anything that looks good in a world of commodities. You know, if it's got an ETF, you know, carbon has an ETF. Who knows? We might trade carbon someday if all these things line up. So we are looking for anything and everything that potentially can help you grow your overall assets. And right now, copper and a lot of commodities in general really are looking pretty appealing to me and to Chris, to us, I should say. So Chris, back to you here. And you know, let's see here. Yeah, I'm going to hand it off to you, Chris. It looks like the Q&A is next here.
This slide, you know, Q&A is something that I want to just thank you guys. There's been a lot of questions going on, and we really appreciate those. We're attempting to get as many answers as we can to you, but this is not the end of the presentation. This is just a reminder, folks, that I want you to put on your calendar. 3 weeks from today, we're going to be doing another webinar, so please mark on your calendar October the 28th at the same time. We're doing this for a couple of different reasons. On that date, 4 p.m. It's going to be 5 p.m. Eastern, 4 p.m. Central, and we'll get that out. Sorry for that typo on that percentage. But what I want to share with you is on that day, we're going to have a question and answer session with Ryan and I that's for members only. And so for any of you people that are members of any of our triple play weekly programs and our premium, this is going to be a time that you can talk with Ryan and I both, and then we're going to send open emails to you beforehand to try to get your questions, you know, of interest. But also we're going to discuss follow-up ideas from today and provide a chance, you know, for you guys to answer questions or ask questions for over an hour. What we're going to be doing it that day, everybody, right after the Fed meeting. And also, Ryan, can you step in, you know, real quickly and tell us why this is an important seasonal window to you on the day we're choosing to get back with everybody on the Q&A session?
Well, that's right, Chris. Thanks. You know, if you buy, you go back to 1950, guys, if you buy on October 27th's close, the next 5 trading days, so you could say the morning of the 28th, the next 5 trading days are the most bullish, historically, the most bullish 5 days. And again, I went back then, doing what I like to do. You go back since 1950, the October 28th has the highest average return. In other words, the best day of the year is October 28th. I think the day after Christmas has a higher winning percentage, which would be December 26th, has a higher winning percentage. But in terms of the overall return, October 28th is the day. So we had a really neat window there, and I also said it's also my birthday, so it's a good day. There's a lot of things going on that day, and I you know, 3 weeks from today, it'll be a lot of fun. We'll have a lot of good stuff, but it's also the most bullish 5-day window for stocks. So Chris and I will definitely talk about that on that day.
Thanks, Ryan. Just a couple of things that we're going to talk about 3 weeks from now. I want to share this long-term pattern, and so one of the last quizzes of the day is, what would you do here? You see this asset, we're looking at, what, 35 years? You see that it's come off. It's at a 38% fib level based upon a 12-year, you know, movement. So again, like we've been doing, thanks so much, would you long, short, or do nothing here? So we're going to launch the quiz, and what would you guys do, guys and gals? So we're going to close the quiz, and we got about a 60% of the viewers would be a purchaser on this line. And so let's dress this chart up a little bit from a power of the pattern perspective. So if we take the emotional highs from the 1980s into the 2000s, and then we tie this with the lows through here, you'll notice a rally, a kiss up underneath, and then quite a decline. And then we can see that in the late 2000s, the financial crisis, it stopped right here, and we're back at that line at that 38% level. You see anything else that might encourage you to take any type of an action, long, short, or do nothing? So let's look at tying in these lower highs, tying them to the high in 2007, and you'll notice that we have a triple support point here. So this very much interests us from a play that we're going to discuss heavily 3 weeks from now, because why this is really important is whatever asset this happens to be could be, in my opinion, the largest head and shoulders top of any asset I've ever seen in my life. And so this could be viewed the neckline, everybody. So this is a huge opportunity from Ryan's going to share the power of the statistics 3 weeks from now, and we're going to update the power of the pattern opportunities of what this asset is at this price point. Another thing that we're going to want to look at is we all know that the coal industry has had a couple of challenges, and obviously it's more than a couple. So 3 weeks from now, we're going to drill down, no pun intended, into the coal industry. And we're going to look at Arch Coal, we're going to look at Cliff Natural Resources, Cloud, we're going to look at coal futures, dig into that. We're going to look at the coal ETF and Peabody Energy. So these are some of the things we're going to talk about, the opportunities that we see that are very rare on 30-year patterns, beat up areas. But the biggest thing that we want to do is just let you know that this is going to be a time for Q&A for Ryan. It's going to be your time for members to pick our brains and get to talk with us for a while. As you know, Ryan's a very interesting guy, so I hope most of your questions go to Ryan versus me. He's a lot more fun than myself. So, as I wrap up, everybody, this is kind of what we want for all of you. I look at this cat, and I think that's one confident cat. So we hope that we've shared some unique perspectives today. We hope that this will help you become confident in many of your decision makings. I just want to share that, we know that you have many, many, many choices for your investment research. And Ryan and I aren't the Holy Grail. We believe in what we do. We're very honored that you're here. We want to be your, the power of the statistic, the power of the analytical performance. We want to be your headquarters for that. But folks, everybody's on a journey in life, and we just hope that you'll include us in your journey along the way. Include us as part of your research. So what I want to do right now is I want to turn it unmuted. Started out this meeting. Rick is head of customer service, and I just want to share. I really think a lot of Rick, and we're trying to do our best on a research side. But I'll tell you, when it comes to somebody taking care of customers' needs and having a heart and really doing a good job, this guy, I know a lot of you have talked with him. He's really a good person. He really cares a lot. Rick, I just want to say, openly to the world, I really appreciate what you do for us as a team and what you do for all of the customers, around the world. So Rick's going to share a few things, and we're going to make some offers that give away some free things here for those people that are on the line. And so, Rick, go ahead. Thank you very much.
Thanks, Chris. Hopefully everyone can hear me. That was very kind and unexpected, and I'm not sure what I owe him now. I'll have to find out when we get off this call. All right, so we're going to cover a couple things here. Let me just see if I can get back to my screen. If you are new to Kimble charting, one thing we understand is investment research is much like a sporting event. Let me see if I get control of the screen here. I don't know if somebody's moving their mouse. Let's see. My page down's not working too well here. Bear with me, guys. We're going to see if we can get this. There we go. So you really don't know if, especially investment research, you don't know if it's real in terms of the value until you experience it. So we want to give you that opportunity to experience things. And so what we want to offer is two invitations today. First invitation is to give you an opportunity to review all of our research. There's some research. Yes, I'm going to go through the products at the end of this for the people who want to stay and go over the products. But For those of you who are new, those of you who aren't familiar with all of our research and would like to take a look under the hood, we want to give you an opportunity with minimal commitment to take a look at everything, see what you like, and then at the end of the period, you can evaluate things and make a quality decision. So the way we're going to do this is with a trial. It's a 7-week trial, and I'll explain how that works. The first 3 weeks are free. And so hopefully in 3 weeks you get daily research, because premium is daily research and updates that you're going to see from Chris and Ryan. That includes some weekly reports, and those reports are sent out every week. So you'll get a chance for 3 different weeks to see the reports, see what you like and don't like, what's relevant and valuable to you. And then at the end of that period, if you want to stay as a premium member, we're going to give you a 50% off discount just for the next 30 days. Some of you might still be questioning at that point, because 3 weeks we know is not a lot of time. But if you're questioning and you decide, I need a little bit more time, we'll give you 50% off for that period of time. For those of you who decide that you know exactly what you want, but it's not premium, at the end of 3 weeks, continue with premium, we said, for 50%, or you could switch to maybe one of our weekly research reports for as little as $1 or $2 a day. And we have different discount packages when you combine them. Also, you could cancel that premium research and just remain a blog viewer. We understand our research isn't going to be for everyone, but we want to hopefully make it as easy as possible for all of you to see what we offer with minimal commitment. Now, there's a link that Emily is going to put together and send to you. Hopefully we'll have some success here where we can send it out right now through what's called a handout. And in your panel, each of you have a panel, of course, to your GoToMeeting. It's on the right side of the screen. Hopefully all of you saw it when you came in. And there's a section on there called handouts. And she's going to do her best to get a link over to you through that and possibly through chat. If neither of those work, we're going to get an email out to you. But if you see a link come through, if you see it in the handouts, and I believe there's one that is showing there. So hopefully you can click on that PDF and open it up and be able to start the trial.
Rick, it is in the handout section, so anybody that you want to just click on that handout section, there's the free trial offer for everybody, in there to see all of our research.
Terrific. So this is the trial offer. We're going to run this through this Saturday. That's a deadline that we set, guys, and gals, just to give some incentive, not only for the trial, but to take us up sooner than later on it. We hope you do. So that's our first invitation or offer, if you will. Second, let me go down, see if I can flip my screen again. There we go. Second invitation is the next webinar that Chris mentioned, October 28th. If you're an existing subscriber, that webinar is going to be free. If you're a subscriber to any research, including the free trial that we're offering today, you attend that webinar for free. Premium members attend all webinars for free anyway. So if you do the trial, you're a premium member. So any webinar we have, as long as you're premium, is going to be free to you. And if you decide, the membership isn't for you yet, you don't even want to do the trial, that's fine. You can attend a webinar. At this point, the investment that we're going to put out there is $69 to attend that webinar. We're going to certainly work hard to do everything to make sure that webinar is very relevant and timely, to give you true time-sensitive information and ideas that you can profit from. So that's partly why we're charging for it if you're not a member subscriber. So we hope you understand that. But they're the 2 invitations that we want to put out there for you. Now, for those of you who hung in there and are still with us, we randomly picked a name from everyone, and I'm sorry I can't give this out to several hundred people, but we're picking just one right now, winner for a 3-month trial, unless Chris changes things, 3-month trial to premium, and that's Alan Newmark. So Alan, this trial for premium to you is actually going to be 3 months, and so you get a little bit longer chance to view things, but we're happy for you. I'm not sure if anybody on the line is really happy for you, but we can give you a little bit of a cheer publicly, and we'll get you out the details, of course, for that. Now, I'm going to bring Chris on just to see if there's anything else, but I'm going to cover the products again in the next couple of minutes for those of you who want to hang in there. But Chris, any last minute thoughts?
I guess just before Rick gets going, we've got between Ryan and I just a lot of research. We're biased, but we think it's quality but I just want to say that if I was in your shoes, knowing what I knew, and we do have a lot of research, I'd just take the free trial that we're offering. And there's no strings attached to everybody. It's just we're going to let you see everything that we have, the daily research, the weekly reports for 3 weeks. And at the end of 3 weeks, it's not for you. That's perfectly fine. This is a journey. That's a long time. We don't look at this as a sprint. This is a marathon. So, knowing, like I said, knowing what I know, that's what I'd suggest you to take up. And we're not trying to pull any funny business. This is completely refundable. We just want to expose everything we have, and we just hope and pray that it benefits you. And so we're very humbled and honored anybody just to give us a chance. This has really been fun. That we have many members that have been around several years, and we're really humbled by that. So go ahead, Rick, and thank you very much.
Okay, so I'm going to advance the next slide. Make sure you keep your mouse still, Chris, so I can move. Let's see if I can get to the next one here. There we go. For those of you who want to try to contact us, well, actually, first, with regards to product comparison, we have a compare research on our homepage. There's a section. I'll show that later. If you want to contact us, this is our email here. You can also contact us toll free. And worst case, all of you have probably been on the blog and or our homepage, so there's contact information there. If you don't write any of this stuff down, that's fine. You can contact us. Just getting to the to one or two of those site, one or the other site. Okay, there's an example. Let me go back here. This is our homepage on our site. You'll see under subscribed it says compare research, and you can when you click that, you'll see everything, a nice summary on all of our research that you can go through the details there. And of course, I'm here at any time. You email me, call me, we can go through and figure out what's best for you based on what you're trying to accomplish. So but what I want to do here is just go through two types of our research, kind of give you a 30,000 foot view, then drill down a little bit, not go into a lot of detail. Again, we can, hopefully this will be enough, and we can go into more detail on the phone depending upon what questions each of you have. First type of research is what we offered that covers select assets and identifies current trade opportunities. So Chris is doing and Brian's doing analysis and research on specific assets, looking for trade opportunities for you to take action on. The second type of research is what we call for research for slow monies. Slow monies are just another way of terming long-term assets, assets that in effect they're traded or reallocated a few times a year. Maybe that's due to the fact that you have clients, you're a financial advisor, and you have clients that you're not going to move their money around often, hopefully limited to a few times a year. And or based on just portfolio objectives, you may not want to be very active. Perhaps you have a corporate retirement plan that has restrictions on how many times you can move the assets. So this is more of an underweight, overweight service, if you will, where we apply this type of research. So if you're looking for active trade opportunities, maybe that's a swing trader. If we could give that a label, this would be perfect for you. If you're looking at slow monies, long-term assets, then perhaps financial advisor situation, or again, corporate retirement plans. So digging a little bit deeper, when we look at slow monies and global dashboard and the shoebox high yield report are two different research reports we offer. And when we dig down to the global dashboard specifically, from a 30,000 foot view perspective, it covers 9 major global assets. Literally, you're going to see a dashboard, and I'm sorry I don't have an example, but just imagine 9 charts in a box, shared every single week, looking at long-term trends, and obviously determine, are they on support, are they breaking support, breaking out of support. Every week you're going to see that from a big picture perspective and know what action to take. Chris is also going to suggest underweighting and overweighting the equity from an equity asset perspective. In other words, he's not really digging down into sectors here. It's just from a 30,000 foot view, equities overall. Do we want to overweight or make some changes to the weighting, looking at things from a week to week basis? We had not made a change to our allocations, I believe, until late last year and into this year in terms of underweighting equities overall. But that's something that we'll share. You may not need us for that. That's just something that Chris will pass along, but you decide, obviously, based on what you see, how you want to change any of the weightings. Our shoebox high yield report is very unique in that it's the shoebox, just a unique term we've given it, but it's a proprietary indicator that Chris developed several years ago in what we also call an advanced warning indicator. Even some of the statistics and things that you saw Ryan put together are looking in some cases ahead of time, not to take action on immediately. That's really where the power of the chart pattern comes in terms of when do you pull that trigger. But it's nice to know some data up front that kind of gives you an advanced warning to at least start paying attention. Hey, we might have a big time turning point in the near future. So that's what our shoebox, if you will, indicator is. And the high yield, everyone looks at high yields, or should be, as another advanced warning indicator. Certainly high yields were breaking down and diverging from the rest of the market several months ago. So that was another great warning sign. So we cover them on a weekly basis. Also, we cover advanced decline data, some pretty good information, obviously, that all of us are familiar with, but important to be looking at and comparing to the other data to figure out, are we there? Are we at a point where we need to make some adjustments? And again, this is slow money, long-term money that we're looking at. These are reports that aren't looking for opportunities to make a trade this week or very active, very inactive. In fact, we're looking hopefully to only make a few adjustments a year if possible. So financial advisors, corporate retirement plans, as I mentioned earlier. Now, the second type of research here is research covering assets and categories that identify current trade opportunities. And our sector commodity report, our metals research report provide those opportunities, specific opportunities in sectors and commodities and metals that when we see the power of the statistic and the power of the pattern line up, we're going to inform you and we're taking action, whether we suggest that we want to long an asset or we want to short an asset, and all that is done by email and includes updates. Whenever we make adjustments along the way, we're going to give you an initial stop. If we change the stop, we'll send you an email immediately to let you know. So it's all real time, if you will. It's not delayed. As soon as we see action to take, you're notified immediately. So our sector commodity specifically is going to cover 9 S&P sectors and several different commodities, looking for opportunities in this case, again, you may want to underweight or overweight or take specific action on those sectors. Completely up to you based on the analysis and research we provide. We also highlight sentiment patterns, not just chart patterns, but the sentiment is a key ingredient in order for us to really pull the trigger. So if a chart pattern is suggesting to buy, in this case, we really are looking for sentiment to be an extreme in order to take action. So look for that as it's a dual combo, or it's a necessary combo for us to take action with this particular product. Now, as a premium member, we may look at that same asset and sentiment may or may not be at an extreme, and we still might take action. So know that if you're really looking for no holds barred, you're not looking for sentiment to be an extreme, but just a pattern, then you would want to be a premium member in that case, but sector looks for the combo. So as I said, both being at extremes. And yes, we also notify members as these events occur, we immediately email you. So metals, same idea. Weekly analysis of gold, silver, copper, and the miners. Highlight chart and sentiment patterns as well. This does not require sentiment to be at an extreme in order for us to take action. It's just a nice backup when it does and increases the probabilities. And of course, that's what we're all looking for, is higher probabilities that we're going to be right when we take action. Again, identify specific trade opportunities, notify you as they occur. So here are the 4 reports that I just previewed. They're $29 a month or $1 a day. So we're hopefully putting together research for you guys and I can tell you what this research looked like back in 2012 when we came out with it compared to what it looks like today. It's a lot more. There's a lot more there. There's a lot more value, hopefully, that you'll get from it. But we haven't changed the price yet. Still $1 a day in effect. A little bit more for the shoebox. Or one of the things we also will do is provide a combo package where you combine these 3 research reports, and you get the 3 instead of for 80 some bucks a month, it's 57 a month or $2 a day. In effect, you're getting one of these research reports for free when you combined all 3. So if that's the way you decide you want to go because it meets the budget and the need, then you may not need premium. But these are the same exact reports that you're going to have a chance to review with the free trial that you do with premium, because they're included with it, which we'll be looking at. So let's cover premium real quick. Several different things that we offer with premium membership that we're going to go through, but it's in effect. The key here is it's daily research, and by daily I mean that Chris is looking for opportunities every single day, and including existing positions that we may have and new positions that we want to bring on board every single day, that we can get out an opportunity to you to help you make some money. That's what our goal is. So these charts and statistics, nothing new. I mean, you've seen them several times from us, but this is the kind of information and data we want to produce for you every day. You go through it, and hopefully within a short period of time, which is our 28-second advantage goal, you see any pattern that's at hand, and you know the action to take. So hopefully with all of our research, you can get through it very, very quickly. Premium research is covering about 11 different investment categories, 50 different assets. So there's a lot we're covering. That doesn't mean you're getting deluged with a bunch of stuff every day or every week on these. The key is we just want to filter out the stuff that's relevant. And the stuff that's relevant is research, chart patterns, and statistics that are at the extreme. That's what we care about most. We find the extreme, and it just increases your probability of being able to profit. So as an example, August 20th, look at the Russell 2000. Long channel. I know you can't see the bottom of this chart. I'm not sure why, but there's a long channel at least for several years there, and you could see how it broke. And when it broke, we took some action on August 20th. And if you look back, some of the worst days, couple days that the market had were just after that. I think 24th might have been one of the worst. And we put a 5% fixed stop on that. We were able to get out of that position actually before the market has turned up and rallied a little bit. So we had a nice 7% gain on the first piece that we took off the table. And so it was a nice opportunity. Email alerts, of course, again, on these new positions. And with anything in premium research, we provide the asset, the action to take, an initial stop, and just brief commentary. Again, we want you to be able to get through this data quickly and take action. Here's another example on CAT that Chris went through earlier, but this was the action. We sent a chart. Chris had a little bit more commentary with this on 925 with a stop at 63. Well, we didn't need to worry about that stop. It just took off immediately after and was up about 10% within 10 days. We'd love every one of those to be like that. They're not all going to be, but it was a great opportunity. Why? Because again, things were at an extreme. And I'd like to point out for any of you who trade options, you know, options for a lot of folks can be very long-term, and some people trade weekly options. I believe, only because I've heard this over and over again from our customers who trade options and they find these extremes. When you find an extreme and it really turns in a significant way, options can be super profitable. We've gotten 100%, 200, 400% returns on Apple and on some metal stocks that people traded using this research. Not encouraging you to trade options, just that if you do, this research has been quite helpful for folks. So updates on stops, taking profits along the way, we call it pocket change. And when we close a position, the only time we don't update you is probably when something is stopped out. We expect everyone will have their stops in place, and we already know you're getting enough emails, so we want to be careful not to overkill. This is just an example, a snapshot of the position report that we send out once a week. We really hope one day we can have this online that you can see it at any given time. But right now we email it out once a week. If somebody wanted a current summary, I could always get it to you. But this is just a nice summary to make sure you know all the positions we have, the stops that we have in place when we change those stops, and we'll also update you on the returns or the gain or loss as well, which you don't see there, but that's also part of the report. Now, I shared with you what premium membership was, in other words, what we've put together since 2010. And but since then, we have added several things to premium membership, including these weekly reports, which we started including and adding back in 2012, that are a $1,500 value, analysis and suggested actions now on shorting the VIX. Some of you are familiar with this, but a lot of folks are not familiar with probably one of the best opportunities out there, and that's shorting the VIX. As most of you know who follow the VIX spikes, and basically it's a bunch of Eiffel Tower patterns. They spike significantly. It's a parabolic up and usually a parabolic down. Not always. 2008 and even recently, we haven't seen that parabolic down so much. But eventually, it's got to soften. It's got to come down, and it usually does in a significant way. And we buy XIV, the inverse, and it has provided some of the best return potential of any asset that we cover. So that in and of itself is a very significant value, only available with premium. It's not a separate product at this time. Pattern analysis on seasonally influenced stocks. Ryan and Chris can, again, apply the power of the statistic and looking for an extreme situation in stocks, just like we did with CAT. And sometimes we also find out that has a seasonal influence, meaning in that particular month, that particular stock or a series of stocks tends to do very well. We will point those out. We don't do it every single month. We really are not looking to short stocks at this time. We're looking at times where we're more in a bull phase. I think this works better, or it seems to work better, focusing on times to go long. But it doesn't mean we can't come to you and share things, opportunities where we're going to short. Special reports that we also produce occasionally to help improve your perspective and on investors and investing. We have now come out with a new report called Coffee with Chris and Ryan. Some of you have seen that report as current member subscribers. And that's a report that we plan on possibly putting out there as a separate product. We don't know yet. We don't know how we're going to price it either, but so that's just an assigned value, but not a specific value. And of course, probably one of the greatest things we've added since 2010 is now the addition of Ryan on the team and all the great data he brings. It's an invaluable amount of research. I really can't put a price tag on it, but when we consider what we charge for premium at $380 a month, at 3,600 hours a year, when we add this additional value, we're really producing about $11,000 worth of research and making it available to everybody at about $380 a month or $1,250 a day. We also offer a 20% discount with an annual membership, which brings it down to about $10 a day. Now, again, go back. The free trial is what we encourage you to take advantage of, so that for 3 weeks you don't pay a dime, and then you pay 50% for just your first month. But from an affordability factor, we hope we've produced some research that for $1 a day or $10 a day, depending upon what you need, we can meet your needs. At least that's our goal. We want to hear your comments. We want to hear your questions, and anything that you feel we could do to improve things, we want to look to do. We have had some customers, and this has been a great surprise, a great honor to have people say, hey, do you have a lifetime membership? Well, we haven't gotten that close yet to offering a lifetime membership. I'm not sure we're going to get there, to be honest with you. But we have put together some multi-year commitment packages which produce or provide for further discounts. We've put together one package for a few folks who wanted a 3-year membership, and we provided a 30+% discount instead of the traditional 20. So we're open to that for those who really find that this research is great. It's what they want, and they want to make a longer term commitment. Happy to do it. So this is a repeat slide. it just goes back to the trial. So we are going to wrap it up. Just to repeat the fact that if you want to experience our research, just like a sporting event, you gotta take time and get into it and take us up on the trial to really figure out whether it's for you. So again, look for that handout and that we sent. We'll send an email too, so you can get the trial started. And I'm about winded, and you guys are probably tired, ready to go home. So I appreciate greatly your time and your patience listening to me cover these things. I'm going to give it over to Chris.
Rick, super job. Thank you, everybody, for sticking around, that has. Again, just like I shared a little bit ago, we're deeply honored that you look at Ryan and I's research. We're putting together what we want to be as one of the best teams on the planet, and we want to provide you with unique perspectives as possible. And as I said again, I appreciate that you gave us a chance to talk about the different research packages that we have. But again, I do nothing more than just give the trial. I wouldn't buy any of our packages. I just give the trial a chance so you can see, and that'll give you at least 3 weeks of looking at our research, all the time. So again, as I said earlier, everybody, we know there's a lot of choices out there. Thanks for just giving us a look, today. We hope to be, providing benefit to you for a long time. And again, our biggest wish is just that through your journey in life, we pray and wish great things for all of you, and we'd love to be, part of your research that you receive in making quality decisions going forward. So again, best wishes. Thank you, everybody. Very humbling day. Take care.